2021 could be a record year for middle market M&A. In a newly published article, KeyBank Capital Markets explores the many factors that are driving this unprecedented volume. To read the report, visit key.com/M&A Insights.
Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast.
Now, I'm very excited about this next guest for a number of reasons. Number one, I've always wanted to be a farmer, and it seems like I'm getting a little closer with new technology. Number two, I'm from Ohio. He's from Kentucky. And I feel like, a lot of states that are next door to each other have rivalries. I think Ohio and Kentucky really complement each other well. Dwight Yoakam was from Kentucky. He moved to Ohio. Sturgill Simpson was from Kentucky. He moved to Ohio. And a lot of people have moved the other way around as well. Jonathan Webb joins us right now, founder and chief executive of AppHarvest. So Jonathan, set us up as to what your company does. As far as I understand it, you basically are bringing tech into farming and really solving some ESG problems as far as food waste is concerned as well.
Yeah, Paul and Matt, thanks for having me. And yeah, I'm a huge Sturgill Simpson fan, and he
from
Versailles, both Kentucky and Ohio. Well, that's right, and we're talking to all those East Kentucky artists now about this, but. I've been in D.C. the past couple of days talking with senators on both sides of the aisle, and what we've messaged is, controlled environment agriculture it's inevitable. It's really the third wave of sustainable infrastructure. You look 20 years ago, it was renewable energy. The world finally caught on. 10 years ago, it was electric vehicles. The world finally caught on. And right now, you can look at the U.S., and we are incredibly vulnerable as it relates to food security in this country. California, drought-stricken, wildfires, the southwest of the U.S. is drying up. CBS just did a big piece on the Colorado River drying up. I'm standing in coal country, eastern Kentucky, and we've talked about mining fossil fuels for decades. What we've not talked about is we're mining our water. We're extracting our water to a point to where our aquifers are not refilling. So AppHarvest, we're building some of the world's largest controlled environment agriculture facilities. We grow a fruit and vegetable with 90% less water and get 30 times more yield per acre using technology.
So Jonathan, describe for us or explain to us what is a controlled environment agriculture?
Yeah, so think of anything you grow indoors and control the environment.
Okay.
So
I'm thinking about weed, by the way. I'm thinking just about marijuana, basically. But
that has helped push the industry technology-wise forward. You look at LED lights,
hydroponics.
Hydroponics. Climate control, humidity controls. So there's several companies out there. We're one of them, and I personally don't see anybody as competition. This problem is so big. And we, as the U.S., are not nearly moving fast enough. The UN has predicted we need 50 to 70% more food by 2050, and we would need 2 planet Earths the way we currently grow that food. We've got to use technology to grow more food with less resources.
The point being, you can grow a lot of other stuff besides weed. I mean, this is not a little Pineapple Express barn. You're talking about big indoor farming operations that can feed masses, right?
Yeah, that's right. And no, we're growing fruits and vegetables. We're definitely not growing the other stuff. We're growing fruits and vegetables. But yeah, we're at scale. It's massive. So to put this in perspective, our first facility in Moorhead, Kentucky is 2.8 million square feet, 60 acres under glass, one of the largest facilities under construction in the world in the middle of COVID is what we built here in Kentucky. We have 4 more facilities under construction. We just went public on the NASDAQ under APPH and raised $500 million, to build out our series of indoor facilities here in Eastern Kentucky.
So, Jonathan, explain to me your business per se. Do you go to existing farmers and say, let us kind of help you get to the future, or what is exactly your day-to-day business?
Well, unfortunately, the American farmers already lost to Mexico. And when I've met with everybody on Capitol Hill last week, that's what we were talking about. We import most of our fruit and vegetables from Mexico because the U.S. is slowly shutting down fruit and vegetable production. So, our competition really at App Harvest, it's the imports from Mexico. 4 billion pounds of tomatoes were imported from Mexico last year. That was nearly 1.2 billion pounds about 15 years ago. So, App Harvest is building the facilities. We're operating the facilities. We're selling to Wendy's, Walmart, Kroger.
Got it. Okay.
So we're selling directly to some of the largest grocers and retailers who see the vulnerability in their supply chain.
How hard is it to get the human? I mean, you've got the tech side covered, and robotics, I know, are all up and working there as well. But you still need humans to pick the crop, right? I mean, how do you get strawberries off the vine? You've got to have people working.
Well, we have robotic harvesters, but we have a lot of people. And look, I'm in Eastern Kentucky, not only because I'm from the state here and I love this state, but we had some of the hardest working men and women in the U.S. powering our coal mines through the Industrial Revolution and on. We hired I watch the news every day.
Right.
People say people don't want to work, and I laugh. We had 8,000 people apply to work at this company, 550 people working now. So we have a workforce here that's going to drive high-tech ag forward for the years to come.
In Eastern Kentucky, that's a great story. Jonathan Webb, founder and chief executive officer from App Harvest. All right, Matt, when I went on my West Coast marketing trip when I was a sell-side analyst and you go to L.A., you have to have 2 lockdown meetings, and then you can book the rest of the day in L.A. One was Capital Group, and the other was Trust Company of the West, TCW. Just monstrous. Today we're joined by Brian Whalen, Group Managing Director for TCW's Fixed Income Group. And why did I have to get that meeting? $253 billion in assets under management. Brian, thanks so much for...
Plus the nicest guys.
Yeah, my media guy on the equity side was a great guy, and I still keep in touch with him. So always a fun meeting to go into to see the folks at TCW. Brian, I'm looking at the 10-year here. I got 1.44%. If I'm a fixed income geek, and I say that nicely, like you, where do I go to get some yield?
Boy, well, first of all, thank you for the nicest introduction I think I've ever heard. Yeah, it's pretty hard. I mean, you talked about the 10-year at 1.45%. That doesn't seem to line up with, equities at the all-time highs, and there's a story behind that. But, looking for yield, I mean, look, within fixed income, the high yield bond market, generally speaking, the highest type of yield you can get, 3.75%. I mean, that's what you get for a generic high yield portfolio. So the Fed has, and the fiscal side of things has done their job to flood the economy with money, suppress interest rates and have, investors scrambling to put any type of yield in their portfolio. Sometimes, I think, regardless of the risk they're taking on the underlying credits.
So what's going on? Why are we seeing yields dump down to 144 now? And how does this turn around if not the Fed's hawkish, change in tone?
I think first I'd say, remember, we don't have a U.S. capital markets. We have a global capital markets. And you think about the things going on around the world right now. So first of all, obviously what's been leading the news and the economy and the markets for a year and a half now is COVID. And we've got the Delta variant going around. And while we may not really see it here so much, it is affecting other parts of the world. Also remember that, 1.45% sounds really low to you and I. You look at the developed world out there, 1.45% looks really cheap. Maybe Australia, New Zealand, places like Singapore, slightly higher. But, you go to Germany, you go to Switzerland, you go to Japan, you're talking about a 10-year yield of 0 or less, minus 20, minus 25 basis points. And then, back here to the U.S., I think, and you focus on the fundamentals. One, I think, investors are starting to, realize that the economy, it may not accelerate in the second half of the year as quickly, as they were anticipating. Instead of adding 1 million jobs a month, we're going to add maybe 600, 700,000 a month, so that might be slower. And then, finally, most recently, the Fed just told us, they said, look, we may let inflation run hot for a little while, but we're not ready to turn in our inflation-fighting badge. And so that's why you saw this flattener. You saw long end rates come down, as the Fed kind of let everyone know that, they're not going to let inflation get out of hand, or they're going to try not to. And you saw short end rates go up, meaning that, the market just started to price a slightly higher probability that the Fed may move a little bit sooner with regards to interest rates than the market was expecting just prior. So you put all this together and then a few other factors, and I think it does explain why we're under 1.5%.
Dude, you had me at negative 20 points on the Bund. I got you.
Yeah, 1.45 sounds cheap now, right?
Yeah, exactly. So, but my question then, and I just want to get your take on this. The dollar is important then. If I'm a euro investor, and U.S., from the perspective of a German, the U.S. budget is like out of control, 120% GDP. That's very un-Deutsch. Does that bother you at all?
I think that's a problem for another day, to be quite honest with you. We could go on and on about the levels of debt in the economy on the corporate side, and as you said, on the fiscal side, and the long-term ramifications for the dollar, and whether that will retain a reserve currency or whether others will kind of share that title. I think in the short to intermediate time horizon, given what the Fed just said, the dollar looks fairly stable, if not will continue to strengthen a bit versus these other currencies. And we've seen that reflect in the bond market. It feels like for months now, you come into, you wake up in the United States and you hear about all this buying of U.S. bonds, whether they be treasuries or corporate bonds from overseas, because of just like we talked about before with the 10-year, just how cheap they look. Remember, we're not just starved for yield. The globe is starved for yield. And every night, these investors from outside the U.S., they come in and they pour dollars in here because even when you adjust for the currency, it's still the best place to find some yield.
I feel you. Brian, thank you so much for joining us. Brian Whalen there, Group Managing Director, Fixed Income and Portfolio Manager at TCW, talking to us about what's going on in markets. By the way, as he was talking, I saw the yen.
Yes.
Well, the dollar jump
yeah.
against the yen. You can now buy 110 yen for your dollar.
By all indications, 2021 is going to be a record year for middle market M&A. There's pent-up demand, there are ample cash reserves, and many economic uncertainties seem to be behind us now. In a newly released article, KeyBank Capital Markets explores the many factors that are driving this unprecedented volume. The outlook for M&As is strong. Find out why. Read the KeyBank Capital Markets article at key.com/M&A Insights.
Let's get over to Everett Millman. He's a precious metals specialist with Gainesville Coins. He's going to talk to us about commodities even more broadly. We'll get into copper and Bitcoin as well. But I want to focus in on gold first, Everett. Good morning. Thank you for joining us. Why is gold not performing the way... Well, look, we've got rates that are coming down, which I would think means gold goes up. The 10-year over the last 3 months goes from 175 to 145, and we're seeing gold that has done a whole lot of nothing at 1763. What gives?
Right. I think part of that is that risk appetite seems to be elevated right now. That's siphoning off some of the normal safe haven demand for gold. But also, we're seeing seasonality kind of return to normal for the gold market. The summer months are almost always unkind to gold, and the only reason that hasn't been reflected in the price the past 2 years is some unprecedented circumstances with the early stages of the pandemic in 2020 and some fluctuations in the repo market in 2019. So I think that's one of the main factors, and also, as you pointed out with rates, I think this is a knee-jerk reaction, an overreaction even, to the hawkishness by the Fed, because if you look at the 10-year yield, it actually fell in response to that, and with inflation rising, that means that real rates, the federal funds rate minus the rate of inflation, is still rather negative. So you would expect that to be a favorable environment for gold, but I think that risk sentiment and kind of the summer doldrums of seasonality are the main factors holding back gold right now.
Everett, I wonder if, Bitcoin is having an impact on how gold is trading. The smart folks around crypto are trying to convinced me that Bitcoin is a store of value, and that's kind of typically how folks have viewed gold. How do you think Bitcoin is impacting, if at all, kind of how gold is trading?
I do tend to agree that it is drawing away some of that store of value appeal of gold into the crypto market, as it's essentially the most appealing alternative to the dollar right now. And although we have seen the dollar been rising, that's been reflected in the Bitcoin price that we've had this significant pullback. But as you pointed out at the beginning, that gold has been kind of moving sideways, hasn't done a whole lot. We don't often see that from Bitcoin. The volatility is certainly a feature of Bitcoin, and I think that appeals a lot to most investors, that if they want to get some exposure to something that is anti-dollar or outside of the dollar, then they'd rather have that greater upside with something like Bitcoin rather than gold, which is fundamentally more boring and sort of a conservative investment.
Also, Bitcoin may be a little bit easier to use in a catastrophe. I like the idea of both because I'm looking forward to some post-apocalyptic world when all we have is gold, guns, and water, right? But you're not going to get 100 cents on the dollar for your gold, and Bitcoin you can just zap over to somebody else. Isn't it, in the end days, going to be easier to use digital currency?
That's a fascinating point, and I do agree that I think a little bit of both is ideal, because although it's true that the digital nature of Bitcoin makes it much more easy to use in those situations, if we're talking about kind of a end-of-time scenario, you would think that some of our digital and internet capabilities would perhaps be offline or off-grid. Yeah. So I think that the physical nature of gold sort of is the backup plan to that.
Could be a Red Dawn. Could be a Red Dawn kind of moment, when the Soviets invade and occupy the U.S. and we all have to huddle up with our teenage friends in the Colorado mountains. Who knows?
Right.
Who knows what can happen?
Everett, aside from gold, where do you see the best, value or opportunities here in the precious metal space?
Well, the precious metals, I think, are sort of mixed right now. Silver seems to be tracking gold, but it is much more sensitive to the industrial metals, to what's going on in the broader economy. And although we have seen some encouraging manufacturing numbers, particularly in Japan and Germany, these potential setbacks with the Delta variant of the coronavirus may kind of crimp that potential. Although it's considered a semi-precious metal, I'm also looking at copper, because some of the impediments, some of the roadblocks to higher copper demand that we've seen are pretty well understood. The crackdown in China, where Beijing is limiting its exposure to commodity inflation, and also in the housing market, the fact that new home sales are dropping, that's a major source for copper demand. But Chile is far and away the world's number one producer of copper. And right now their legislature is considering legislation that would impose pretty steep taxes on their copper miners. So if that were to come to pass, it is estimated that about 1 million metric tons of copper output from Chile would be in doubt. So on the supply side, I think that copper does have some potential headwinds, and that these supply concerns would mean that prices won't fall quite as far as many are expecting.
All right, Everett, thank you so much. We always appreciate chatting with you, getting the latest on precious metals. Everett Millman, he's a precious metal specialist at Gainesville Coins. Let's talk tech. Let's talk cybersecurity, chip shortages, all that good stuff. Nicola Marini, Chief Technical Officer for EY, joins us. Nicola, thanks so much for joining us here. Love to get your thoughts on, I'm thinking cybersecurity. We've seen a lot of ransomware hacks, and I was just going to ask myself, doesn't corporate America, or just the C-suite in general, get it that they need to spend money to protect their systems? What's the latest?
Yeah, so hi guys, good morning. It's great to be here. Thank you for having me. Exactly. I think it's a very bizarre situation, actually. On one side, cybersecurity is on the front page everywhere, right? And then on the other hand, we're not seeing the same type of reaction in terms of the prioritization of investment for cybersecurity. So I would summarize it as a sort of on one side there is alarm, effectively almost panic in some elements, and as well at the same time, with sort of an important sense of resignation and say, this is something that sooner or later is going to happen to us, and we're going to sit and wait. So we had done, for example, a survey very recently, and we see that, for 70% of the CEOs that we have interviewed, data and technology are considered, the base of their future growth. And at the same time, only 1/3 of the same CEOs see cybersecurity as a top priority. So it's kind of puzzling.
Well, I guess the ransomware attacks are the alarm sounding, and maybe they're going to start ramping up spending. By the way, I love Ernst & Young. The word for the business that you're in German is Wirtschaftsprüfungsgesellschaft. Wirtschaftsprüfungsgesellschaft. That's one word, 32 letters. I just thought it was
For
pretty
what?
good.
What is that? What is that word?
I didn't know that.
It's professional services, auditing, taxes, financials, all rolled up into one. And obviously, EY is one of the biggest in the globe. And, you advise businesses from mining to real estate, tech, you advise finance and government and automotive, the automotive industry. So I wanted to ask a little bit about the chip shortage. This affects more than just cars, obviously, but they're most important to me. How soon do you expect companies to be able to solve this issue?
Yeah, I think the time horizon is still probably between 1 and 2 years still. Because there are systemic issues, right, that actually led to that problem, almost like a perfect storm of, I think, a little bit of an obsolete way of planning, right, very localized for some companies where they look at the supply chain in components versus looking at the supply chain as a system. And so that led to, compounded with the pandemic, maybe, very conservative estimates around potential growth, et cetera, all contributed to a massive clog. This is one almost in a lifetime, case study for poor planning in a way.
So explain to us, Nicola, the, digital twin concept and how that might be impactful here as we think about this global chip shortage.
What are digital twins?
Yeah, so the digital twin is effectively like the digital representation of a system, right? And so it started with IoT in the manufacturing space where, you could build, for example, I think General Electric was one of the first ones to actually launch the concept where they were able to build a turbine in a computer simulation. And so using that, you can understand, what are the impacts of changes in some of the variables that this particular system was experiencing. So if you take that concept and you actually evolve it from a very specific subatomic process, right, into the whole system, I think you'll be able to capture, the signals that you're seeing in the system itself and be able to react, even if you don't know exactly how things will play out, but the ability through technology and the gathering of data to understand the correlation across the variables that you're seeing and how they evolve in time, I think at least raises those red flags that in the case of the chip shortage, nobody has seen coming.
What's the competition like? I'm always interested to hear about the Big Four, and you guys are truly the heavyweights of the world. What's it like coming out of COVID, competing with the likes of KPMG, PwC, Deloitte, and EY?
Yeah, it's a fierce competition, but I think you're seeing actually very strong growth across the board for the professional services business. Okay, so lots of new things happening in a very dynamic world, right? New regulation, new things, and so there is an evolution of the marketplace. I think that is rewarding.
Right.
All of us.
Hey, Nicola, thanks so much for joining us. Really appreciate it. Nicola Morini, Chief Technical Officer for EY.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.